Good morning, everybody. It's 11 o'clock, so let's crack on. Welcome to QuotedData's weekly show. As usual, I will run through the sort of highlights of the news from this week. Then we have our sort of panel discussion special, which is on pharmaceuticals and biotech. Our special guests are going to be Paul Major from Bellevue Healthcare Trust and Marek Powszemski from International Biotechnology Trust. But as I said, first news, actually, which has a big focus on mergers. And I wanted to talk about three of these. So first is European smaller companies and European assets. The way things are looking is we're going to hopefully see sort of European assets rolled into ESCT. And then also we've got more on PHP and Assura. And then last is Tritax Big Box REIT and Warehouse REIT. So first one, European smaller companies and European assets. The proposals are for sort of European smaller companies to absorb European assets. For those that are interested in the fine detail, it's proposed it's going to be a sort of scheme of reconstruction under sort of Section 110. But the idea is that the enlarged vehicle will continue to be managed by Ollie Beckett at Janus Henderson. Each shareholders are going to have a sort of cash exit option up to sort of 15%. And, if people sort of bid in excess of that, that will be sort of scaled back on a pro rata basis. So we want to work on a sort of formula asset value for formula asset basis. But if things sort of proceed as planned, you should end up with a vehicle that's about £780 million worth, which will make it the largest trust in the sort of European smaller companies sector. Now, the sort of merger is designed basically to deliver scale, improve performance, and sort of lower cost. You're obviously going to end up with quite a bit bigger vehicle, so you should see good or sort of better liquidity in the secondary market. Being a sort of much bigger combined vehicle, it should sort of stand out in what is quite a niche sector. And I think the sort of key thing is that European Smaller Companies Trust has delivered sort of consistently stronger long-term sort of NAV total returns than European assets, which is really why a lot of this makes sense. And sort of European assets has been under pressure for some time, which really is sort of why we are kind of come to where we are. Just to give you sort of sense of scale of that, over the last 10 years, European smaller companies has returned 194.8% versus European assets 66.1%, which sort of kind of brings me to the point that when we were sort of back in end of December and then early sort of this year, and Saba was attacking European smaller companies trust, there was this big question of, why would you want to do this given its sort of strong long-term performance? But anyway, I think this being a sort of larger vehicle would probably make the whole thing just a bit more indigestible if anybody does want to come after it. The sort of idea for European asset shareholders, they should see some discount convergence, and I should be able to show you that on the next slide. We've got a chart of it. But prior to the announcement, European smaller companies was on a 7.3% discount. European assets just, slightly north of 10%. As of last night, when I was sort of looking at the figures, I mean, they are practically there already. It's almost as if the market thinks it's a done deal. Now, there's going to be some sort of alignment of dividend policies. For those that are familiar with European assets, it pays sort of 6% of NAV, but sort of spread out quarterly over the year, which seems to be an increasingly kind of popular policy. The idea is that the enlarged vehicle is going to pay 5%. Now, for sort of ESCT shareholders, that's going to be a material uplift in yield, sort of versus the 2.4% that they're getting. And obviously, it's a lot closer to the 6% that European assets has traditionally paid out. You can sort of see it here if you look at the bottom of this. Obviously, this is share price discount chart for European assets over the last 6 months. And if you look at the discount chart at the bottom, you can see with the announcement that actually the discount has moved in a chunk. Other sort of benefits are that they're going to be reduced management fees, which should lead through into lower ongoing charges. Basically, assuming that it completes, Janus Henderson has said that they will reduce their base management fee. The sort of first tier, up to 800 million, they're going to take basically 50 bips off of that. So that's going to pull from 0.55% to 0.5%. And then 0.45% above that is going to remain unchanged. Large trust or large trust ongoing charges are supposed to be around sort of 0.70%. Now, obviously, that's a fair bit lower than European assets, sort of 1.01%, but not necessarily a great deal different, if anything. Potentially higher, but I can't see that happening. The sort of 0.67% that ESCT had at the end of last year. As sort of part of this, Janice Henderson has said they are going to make a contribution. So whatever assets transfer over from it, they will basically rebate their sort of management fee for 9 months. And the idea is that with the 2% discount on the sort of cash exit option, overall, this should actually be sort of cost neutral or near neutral for both sets of shareholders. But I think if you can see the sort of NAV convergence, etc., and the superior performance, much bigger vehicle, this looks particularly advantageous for each shareholders. There is more on this in the article on our website, but sort of shareholders both can expect a circular in September. Next, I wanted to talk about sort of PHB and Assura. Now, Assura's bid or board is now recommending improved bid from PHP. The idea is that Assura shareholders will now receive 0.3865 new PHP shares and 12.5 pence in cash, and they're also going to get a special dividend of 0.84 pence per share. You roll all these together, and basically it values Assura at 55 pence per share, which is a 2.2% increase to the value of its previous offer. 47.1% premium to Assura's closing price before the whole offer period started, and it's a 9.1% premium to Assura's NAV. It's also a sort of 9.1% premium to the other bid from sort of KKR Stonepeak. Their sort of best and final cash offer was 50.42p, and this is quite a sort of chunky uplift on that. The way this is actually going to work, Assura shareholders will actually end up with about 48% of the combined group's asset. I've got a quote here from our Richard Williams, our property analyst, which he describes as a great result for Assura shareholders. Obviously, many real estate and real asset companies have been taken out privately at sort of discounts to NAV. This is getting a chunky premium, and probably for a lot of Assura shareholders, who have been pushing for the merge with PHB, because of course it will still be at discount and there's still the opportunity to sort of crystallize some of that uplift. This is pretty sort of good result from them. The one, I think, cautionary thing is that the combined group will still have quite large debt pile, over sort of 50% loan to value. That's going to require, sort of larger number of disposals to bring it down to the sort of 40-50% target range that PHP has. Next one, Tritax, Big Box REIT and Warehouse REIT. So the proposals are that Big Box is going to acquire Warehouse REIT. The deal trumps current Blackstone offer. If it goes ahead, Warehouse REIT shareholders are going to get 0.4236 new sort of Tritax Big Box shares and 47.2p in cash. Warehouse REIT shareholders are also going to retain the sort of 1.6 pence quarterly dividend declared for the 25th of July, and they're also going to get the next one on the 6th of October. But if you roll these all together, basically it gives you a value of 111 pence per Warehouse REIT share, 114.2 including the divs. Whole thing values Warehouse REIT share capital about 485 million, which is a sort of 38.6 premium to the sort of closing price before all the bidding commenced. And it's also around a 5% premium to the Blackstone offer. It is a small discount to the last reported sort of EPRA NTA of 128 pence. But I think overall, this is a sort of very good deal. Once again, asked Richard Williams, I've got a couple of quotes from here. He basically says the Blackstone deal was substantially undervaluing the company. And obviously this doesn't. And the other thing is, just to sort of go back to what I was saying about PHP and Assura, it is the second time in a week that a listed peer has come in and seemingly beaten off competition from private equity bids following, the PHP recommend offer for Assura. In his view, may long it continue. We've seen too many REITs taken out by private equity on the cheap. And as I say, there's lots more on these stories and others on our website. But really now I want to move on to our sort of panel discussion. Obviously, there's a disclaimer here. Please take some time to read that.